Let's begin.
Vinod, can you put your presentation in full screen mode? Yeah.
Yeah. I'm just,
yeah.
I hope all of you got the presentation in the full screen mode now. Okay, so we begin. This was an introduction which Rajesh put it really very nice. And let's move on to this. What we are going to cover today is loan terminologies. As most of you would like to know, certain terminologies that's getting used as a part of this moratorium getting discussed. We will touch very basic concepts and terminologies that we talk about. We will help every participant in today's call to understand how we will be able to construct one repayment chart for a given loan. And we will get into how the interest is charged, how the loan amount is reduced after every installment, and what are the formulas to that, and how one can look at his own repayment and the scenarios that come across during the life of the loan. We will also talk about the moratorium guidelines issued under RBI COVID-19 loan moratorium guidelines, and we will talk about the options that got created because of this particular moratorium, and out of these options, what are the options that one has these options available, and how to use those options. Are there any better ways of managing such impact during the process of the loan repayment? Because these are not the scenarios that anybody expected maybe even 1 year back. So suddenly, now that this scenario has happened, and probably maybe once in the lifetime of the people who have taken loan, we will obviously understand of with my background being from a risk, is there a way that one can protect himself or herself in such a scenario where your repayment is stopped by RBI saying that please don't pay your EMI for a while? And does it impact you positively? Does it impact you negatively? We'll get into that. So moving on to the next. So let's begin with loan terminology. Very simple. First thing first, loan amount. This is the amount that one borrows or takes as a loan from the bank, finance institution, housing finance institution. Most of the time, this amount is given to the user, that is the customer. In case of personal loans, in case of business loans, it comes to you and you decide how to spend this amount. But in case of a housing loan or a car loan or a two-wheeler loan, consumer loan, the amount will be given to the person supplying the product to you or the goods to you. Say example, the housing loan disbursement will be given to the builder who's selling the flat or the house, and you would be the person who will take the possession of that flat with the help of this loan. So the loan is disbursed for you to the builder. But whereas personal loan, the amount will be credited to your savings or current account. So loan disbursed does not necessarily mean amount is transferred to you and then you use it. It is about the loan application, the purpose of it, and the use of it. Loan amount can be disbursed in parts. Example, if you are buying a house and if the house is under construction, the bank or the finance company may choose to give the installment base payment to the builder or to the supplier of the product, 20% at every slab, and maybe 4 or 5 times the amount can be disbursed. and this is only an example. It can also mean that you're buying a car, you go to the dealership, one single payment to the car dealer and the car is yours. So it need not be always necessarily be a single payment or a multiple payment. It is all specific to the loan that you take. Principal amount, this is the amount borrowed, or the part which is paid by every installment. You keep paying the principal that you have taken. So obviously if you have taken a 50 lakh loan, you are not going to pay that at a single point. You are going to obviously pay this in installments. So every time that you pay installment, there will be some loan which will go out and the rest will go as an interest. So the amount that you pay towards your loan is called as principal amount. Tenure, this is something which every person who takes the loan and the bank which gives the loan pre-agrees that your loan is for 1 year, 5 year, 20 years, whatever is the type of loan. A typical loan for housing can be a little longer, a 15 or 20-year loan. A car loan can be a typical 5 or 7-year loan. A personal loan can be a very short loan for 3-year, 1 year, 3-year, 5-year kind of loan. In fact, some of the consumer durable loans can be as low as 6 months. So tenure is something which you have agreed that number of installments that you will pay per month, that number is the tenure. Interest rate, this is the rate at which you agree to pay the interest, and obviously that is the amount that you pay as a charge, as a service that one has given you, of providing money to you and charging interest to you. Okay, I hope these basic concepts are something which most of you are familiar with, and if not, probably we would have clarified them. Let's move on to the next topic that we are going
Vinod,
to
1 minute.
cover as a
Vinod, 1
yes.
minute. Everyone, I have written 2 queries on the chat. What interest rate you expect for home loan, personal loan, and car loan? Which product has lowest interest rate and why? Just try to understand as we go along with the product. The main objective, as I said, is domain knowledge and calculations in Excel. So you should also try to understand this. If you don't have answer to this, you can ask this later to Vinod.
Yes, Rajesh, thank you for guiding the team towards getting into this area. Very interesting question. We will answer this as we go along, and if not, towards the end of the session. So now we get into little more technical bit of it, and this is more to continue with terminologies like uh, interest amount. As we have seen, every installment will have interest and the principal, and obviously the amount that you pay as an interest uh, every month. When you pay the installment, some amount will go towards interest, and that interest is obviously calculated at the rate which is agreed, as we have seen in the previous chart. So when you start a loan, by now we have come to the definition of EMI. We certainly know that a person, when he starts a loan, he has agreed upon the loan amount that he takes, the number of months or the number of years that he wants to repay, and the interest rate at which he wants to pay. All this combination put together will formulate a amount that he or she should pay every month back to the bank, so that at the end of the total period, the amount which is borrowed is returned along with the agreed interest to the bank. And that calculation is called as EMI, equated monthly installment. I'll take a very simple example and explain why a need of a EMI. If somebody has taken 20,000 rupees from his friend, and it is agreed that I will pay you all 20,000 at one go, and obviously because it is a friend, it may or may not carry an interest. All what you're going to do is after 3 months when you get a money, or 6 months when you get a money, you are going to go across to the friend and say, here is your 20,000. So this is called bullet payment. There is no monthly installment involved in this. But the amount that you borrow is maybe 50,000 rupees, and your friend is not, who can certainly afford to put so much money with you for a longer period. So you both agree that, okay, fine, you take 50,000, but over next 10 months, you pay me back 5,000 rupees every month. So now what you're doing is you are paying the principal at an equal amount every month. This is not EMI. Why this is not an EMI? Because it's still a friendly loan and it does not carry interest. But when you take a loan from the bank is not your friend. While of course most of them are, but in the commercial sense, they are not your friend. And therefore, what bank is going to charge you interest? So every month, if you pay back 5,000 rupees, you will also have to pay the interest to the bank. Now, here comes one very important question, and I want participants to really understand this concept. So, month one, when you have taken the loan, your total money used from the bank was 50,000 rupees for one full month. But month two, when you have paid 5,000 rupees back to the bank as a part of the agreed payment, now the money left with you for using for the next month, month two, is only 45,000 rupees. So if you had agreed for an interest rate and you have paid the interest at the end of first month, 5,000 plus interest on 50,000 rupees, the next month you are going to pay 45,000 rupees and the interest along with that, and which means your amount that you are going to pay to the bank every month will keep reducing, because you are going to pay 5,000 as 5,000 10 equal installments, but the amount that is going to be paid as an interest will reduce every month, because you are going to use 50,000, 45,000, 40,000, 35,000, and so on and so forth. To every time keep calculating how much is the interest to be paid is a very cumbersome process. And imagine if you have taken a housing loan for 20 years, you have to do this calculation 240 times. So to that extent, a very simple financial innovation is called equated monthly installment. This method allows us to actually take all these three things into consideration, that is loan amount, interest rate, and the number of installments agreed to be repaid, and actually form a formula which gives us a one single amount. If repaid every month, the total principal and the agreed interest will get delivered back to the bank exactly at the same agreed rate for the same agreed period. So if you have agreed for a 10% interest rate, EMI chart or the amortization schedule that we are going to talk in next couple of minutes will obviously mean that it will deliver 10% interest. If you have taken a loan for 5 years, it will exactly end at 60 months. The EMI chart, due to the formula, arrives at such an amount that it actually fits both the criteria for the given loan amount. So as rightly put in the next line, equated monthly installments are used to pay off both interest and principal each month, so that over the period specified number of installments, pay off the loan fully. So every EMI has to have a component of principal and interest. This combination for every month will change. There will be a higher interest initially and lower principal, but towards the end of the loan, there will be a lower interest and the principal will be higher as a part of the equated installment. If whenever we are now going to move to take support from Rajesh and his team to make us understand how to use Excel, we are going to look at how a EMI formula is easily available on Excel. We are going to look at that, but after a while, right? So let's move on to the most interesting part of this discussion, amortization schedule. So as a part of this amortization, what we are going to look at is what is the actual process of creating an amortization. Amortization is nothing else but action or a process of reducing or paying the installment at a regular or the loan at a regular period for a regular amount which is agreed, right? And amortization schedule is a complete table, as I mentioned just few minutes back. If you have taken a loan for 5 years, your table will be of 60 rows. If you have taken a loan for 10%, the every installment that you pay will show you a arithmetic calculation of previous month's balance is being charged with 10% per annum, charged at a monthly level. So you will be able to verify any row, any column, any cell, and see whether the calculation meets the criteria of the loan agreed. The principal amount is being charged, this interest rate at agreed level, and is being obviously repaid on a monthly basis. So the mathematical formula for EMI is given here on the screen, and obviously for the formula, the P stands for principal, R stands for interest rate, and N stands for number of monthly installments. Because mind you, we are going to look at EMI as equated monthly installments, right? So is it possible to calculate an amortization chart for a quarterly payment and a yearly payment? And the answer is yes. The mathematical formula will change a bit, and the calculation methodology will change a bit. But as we all know, the most popular method of paying the loan is monthly. People get their salaries on a monthly basis. Most of the people want to pay their utilities on a monthly basis, and in the businesses. So banks are also very fond of taking it as a monthly. Even the regulators ask for a very simple norm that you must charge interest to a person who takes the loan on a monthly basis. So RBI guideline is to charge interest on a monthly basis, and therefore the uh, the repayment also is on a monthly basis from most of this thing. So when we are talking about the interest rate, particularly, one has to understand the general terminology is to use the per annum interest rates. So we say 10% interest rate, and that is for the year. But your installment calculation is a monthly activity, and therefore you will see on your screen, we have given a specific explanation that if you are going to talk about an interest rate of 11% per annum, then your formulae, which is given here for the mathematical formula, will have to be factoring it by dividing it by 12 and then taking it as a percentage. The whole idea is that This is only a mathematical formula. Hopefully, if you get into Excel, you never have to use this formula, because such a complex calculation, which is maybe 4 or 5 formulas and brackets and a raise to be solved, it's simplified with just a function called PMT as a function in Excel, and it's a ready to use formula. You don't have to calculate too many details. As long as you know the P, the R, and the N, Excel can do this calculation for you. You don't have to actually calculate this at all. On the amortization, I am very sure most of you will have few queries. You will obviously think that this is a bit technical. The best way to explain this is to get on to an actual chart and present to you one example of what is a amortization chart look like and how is it used in the real life. So we will try and do that as a part of this presentation. Here it is. So Rajesh, I think we should take a a bit of a this thing here to understand how this Excel is used for making an amortization, but just to bring the things to a common platform. As we mentioned, we are talking about a loan amount, we are talking about interest rate, and we are talking about the number of months. These are the only inputs that we have taken. And obviously, for the understanding of the table, we have to take a start date. So we have taken a start date as 1st January 2010. Over to you, Rajesh, to explain how amortization is constructed.
Sure, I'll take that. Participants, I hope you already have downloaded the Excel as shared by Vinod and on our meetup, and my colleague Himanshu has been sending that link frequently. So in case you have not downloaded, I request you to basically download that. I'm opening the Excel on my screen. This is the Excel which we have already shared. A few people, if it would be great if you can send a chat message saying yes, we have got the Excel. This will give me the confidence that the Excel sheet is available with you. Till then, I'll wait for a minute or so that others can download it. Yeah, so there are some 7-8 messages which have already come, which says that you have got the Excel sheet, and I assume my screen is also visible to you people. Give me a couple of confirmation so that my screen is visible. Yeah, so a couple of people have said yes, visible. Thanks, Trilo. So let's try to understand what Vinod has been trying to say. In the screen, what you can see is I have taken a reference date, which is 1 Jan 2010. Assume you as a customer have taken a loan on 1st of Jan 2010, and you have taken the loan for 20 years. The rate of interest, current renewing rate in market is around 9%. In last 1 year, there has been a significant drop in repo rate. Interest rates are related to repo, and just yesterday, RBI governor again reduced the repo rate by 25 basis point, 0.25%. So current renewing rate is around 9%. This 9%, as Vinod mentioned, is annual, and we have to convert it into monthly. So we have converted it into monthly, and the formula is very clear. If I put that, it is equal to the D2 cell divided by 12. Let's assume the loan amount being taken is 50 lakh. Excel provides you an easy function called PMT, which I have highlighted if you can go to cell F3 and see the function, it is equal to PMT, and this function requires 3 parameters. I just open up the function. It says you require rate. The rate of interest has to be specified in a monthly terms. Then it requires the number of installments, because I'm taking a 20-year loan. So I say 20 into 12, 240. So these are number of installments. And it says principal value. Now I have put the principal value in negative. The reason why I have put in negative, if I put it in positive, the number will come negative. Okay. Or I can just say multiply -1. Please understand, the concept is when the bank gives you a loan, that 50 lakh is credited to you. That is called cash inflow. Now, when you pay back the money to bank, it is a cash outflow. So EMI is a cash outflow for you. That's why EMI has to be shown negative. But for my calculation purpose, I require it to be positive. That's why I multiplied it by -1, or I make the principal as negative. Either ways is okay. So this is where I got my monthly EMI. I'm sure so far you have understood it because it's simple, some input of data. But now the entire amortization schedule, this entire table which is there in front of you is called as amortization schedule. This is the schedule which, when you take a home loan or a personal loan, the bank is going to give you, saying that this is your schedule of payback. On 1st Jan, bank gave me a 50 lakh loan. For simplicity, I'm assuming every month on 1st I have to pay. Some people who are there online would come from banking domain. They would know that there's many concepts like pre-EMI, broken EMI. I'm not talking about all of those complicated things. I'm going simple. I don't want to complicate matter. So whatever is the date on which I take the loan, 1 month down the line on the same date, I have to pay my EMI. It's a simple assumption which I am making. So this 50 lakh, 1 month down the line, I have to pay back the interest. The interest, if I have to compute on this, 50 lakh multiply 0.75 gives me the interest amount which I should be paying. But what is the amount I pay? Is the EMI, which is 44,986. So here I am putting this number constant. If you see in this cell, this number has been made constant. Every month I'm going to pay 44,986. Now this EMI, as the equation was shown to you, EMI equated monthly installment has got two components. One of the component is called the interest, other is the principal that you pay back. So the interest that you're paying is 37,500. So I take that. So what is the principal that you're paying? 44 minus 37,500, that is 7,486 is the principal that you have paid back. So end of 1st month, how much is the loan amount outstanding? The amount of loan which is outstanding is 50 lakh minus the principal which you paid back. So on 1st February, if you go, assume you have won a lottery. Because of lottery, you got 1 crore rupees in your account. On 1st February, if you go to the bank and say, I want to pay back my entire loan, the bank will say, okay, pay me 49,92,514 rupees because this is the principal amount which is outstanding. You may say, I paid 44,986. So my outstanding should be 50 lakh minus this amount. So why are you asking me 49,992,000? Why not 49,55,000? My friend, on that 50 lakh, there was an interest. That interest was 37,500. only 7,486 was on the principal that you paid back. That's why you have to pay in case you want to foreclose because you got a huge bumper money from lottery. You want to foreclose, you will have to pay 49,92,000. In case you don't close up next month, the interest will be computed on this 49,92,000 and the interest would be computed again at this 0.75 percentage. This would be 37,444, which I have shown here in this cell. So if you see this, each month when you make a principal, when you make a EMI payment, there is a principal component and the interest component. If you just focus on this cell where I'm now highlighting and moving my cursor down, you can note that the interest component is reducing. The adjacent cell, which is the E column, you see the principal component is increasing. Interest is going down because as months pass, you have paid back certain amount of principal loan amount. So the overall loan which is on you reduces. So the interest component has to keep going down, down and down, and the principal amount which you pay each month keeps increasing. So this is how at end of 240 EMIs, your outstanding becomes zero. You do not have to pay any money. This amortization schedule, if you come across for the first time, it may seem difficult to understand. As such, I'm going to pause for a minute or two for each of you to play around with the Excel which has been shared to you. At the same time, I would allow you to see the formulas that I have put in this Excel so you can understand the amortization schedule better. End of the minute or two, if there are any queries, you can put that on the chat box. I have muted myself so that there's no background noise, but I am there online. Kindly play with the Excel. I also asked a query in the chat box asking you people, of the three products, personal loan, home loan, car loan, which product will have lowest interest rate, which product will have highest interest rate, and why? Couple of people have responded. I would appreciate if others people can also respond to this because it's a very interesting query. Some people have responded the answer is wrong, but I'll then later on come on to more reasons why that answer is wrong and why which product gets lower interest rate and why other products have higher interest rate, which our friend Vinod will explain in detail at the end of the session. But at the same time, your involvement is expected. Any queries on amortization schedule? If there are no queries, I'll pass the control back to Vinod so he can explain the moratorium. One of the objective was also to understand Excel. So here you can also see how you can do complex calculations in Excel. Yeah. So I have got a query that I am paying back 54 lakh back. So basically, I sum up all these EMIs. If I sum up all of these EMIs, I'm actually paying, if you can simply add, I see at the bottom, I am actually paying 1,07,96,000 rupees for 50 lakh rupee loan. My friend, we are paying for this loan of 20 years. For this loan of 20 years, if I sum up all of these EMIs, the number come up to be 1,07,96,000. Whereas I took a loan of only 50 lakh, which means I am paying back 57,96,000, which is approximately 58 lakh rupees more to the bank. Okay, but please understand, you have taken a loan on interest. The total interest amount that you're paying is a whopping, it's a whopping 57 lakh 96,000, 58 lakh rupee. That's why if you have a loan, it is always advisable, pay back the loan as soon as possible. If you have got money, if you have, yes, Mohan, if you have money at hand, pay back the loan, which is what our friend, our speaker Vinod is now going to explain in detail. So Vinod, I'm passing the control back to you.
Rajesh,
Yeah.
thank you. And uh, that was really a lovely explanation for the Excel. Rajesh, you are right. Uh, all the participants who are seeing Excel calculation of this nature for the first time should save this Excel with them, use this Excel even after this session, and understand that computation of a EMI amount is a financial magic. And I'm using the word magic is how for 240 months when you pay a same amount, the interest is charged every month for the same percentage, and the balance becomes zero exactly due to that amount. If you increase the EMI amount or reduce the EMI amount, your principal will not become zero. So while it seems to be a very simple three component formula, it is a kind of a financial magic that one has to do for arriving at this particular number. But of course, with the help of Excel, it is very, very simplified. So take a help from experts like Rajesh, understand how to create these charts, how they are helpful for financial professionals and to the customers and all the other participants in the loan business. I was also listening to the queries that are getting raised. I was also seeing the kind of reactions that are coming, and they are very interesting. And that makes it even more interesting to understand the next part of our presentation. So now that the most of the business activities have stopped and COVID has put us under a full stop for a while, or a comma at a while, RBI, Reserve Bank of India, has come to the help of all the people who have taken loan and probably may or may not be sure of getting their salaries, their business income, and a time of uncertainty. As a principal bank of the government of India, they have announced that all the finance companies, banks have to take some steps to help the customers. What are these steps? Let's get into that. what is moratorium? Let's begin with this. So we come to the crux of this presentation for the day, after understanding how to create an amortization schedule, because when we understand the amortization schedule is when we are going to understand what is moratorium. Moratorium means a legal and authorized method of a debtor to postpone his payment. So as we have all seen in the amortization chart, the number of months for which you are going to pay your installment was already agreed. In 2010, in the given example, it was agreed that you will pay the loan for 20 years, which is 240 months. Now that in 2020, suddenly one fine day, neither the bank was aware nor the customer was aware, and the government and the Reserve Bank of India has announced, stop paying your installment. It is legal, but even if it is legal, it is going to have an impact on both banks, customers, and it is going to have a lot of impact, and it is very important to understand what is that impact going to be. So the very sense of it, the Reserve Bank had said, for 3 months, the period of uncertainty, don't pay your EMI. Let's get to what bank has actually come out in the media and the press release and said. This is what the bank had said. RBI COVID-19 regulatory package. The Reserve Bank has declared that banks and the finance companies and housing finance companies to provide a 3-month moratorium for EMIs which are due from 1st March to 31st May. So your installment, if it is falling due from 1st March, 1st April, 1st May to 31st May, you don't have to pay that on the due date to the bank, is what is the regulatory instruction is. And what all you're not supposed to pay. You are not supposed to pay any principal which is due, any interest which is due. So in our case, both put together is a EMI. So obviously EMIs are not supposed to be paid. You are not supposed to pay any bullet repayments. So there is possibility that corporate loans, not the individual loans, but the businesses, big business houses, when they take a loan, they agree on the terms that we will take a loan at a particular point and repay one whole go at this thing. They do not believe in paying the installment basis. So even the bullet repayments are, if they are falling due, they are not to be paid. Equated installments are excluded, and even the credit card due dates will be postponed to 1st June 2020. Now, this was the directive from the RBI to provide a 3-month moratorium. That is what the first line reads. Read it very carefully once again. It says provide a 3 months moratorium. So most of the bank and the finance companies and the housing finance companies, starting 27th of March, started putting on their website and the communication that customer should approach us that I want to avail a moratorium. And therefore there was a bit of a chaos that whether people are supposed to be applying, or is it that the RBI has decided so it is applicable to everybody. So on 6th of April 2020, RBI has further given a classification that even if there is no instruction from the customer, everybody will be by default considered under moratorium. So now the banks have come up with a new requirement. If you want your EMI to be deducted from your repayment account, you have to go and tell the bank that yes, I want my EMI to be deducted. So this situation currently is a bit of a chaos. Every individual has to go back to his or her bank and understand how are they managing RBI COVID-19 regulation. If by default your EMI will be collected, then it means that the company or the finance company or the bank has not given you the option of going into moratorium, they have considered you as a customer who want to continue repaying EMI, not avail the holiday. Whereas if the instruction is that unless you come and opt for paying the EMI, you are by default under moratorium. That means your company has decided not to collect your EMI, and even if you have a balance in your account, your EMI will not be deducted. Both these scenarios will have an impact on the person who is repaying the loan and the banks, of course. What is that impact we will understand, but before that, very, very important clarification I want to give it to people who are onto this chat for a better comparison. Remember the third point which we have given here, and this is clarification even from the Reserve Bank. The duration of the loan will be extended. However, the interest will keep on accumulating during the period of moratorium. What it effectively means is we all our life keep hearing that government keeps on waiving some socio-economic loans, and those people, because a typical example which comes to my mind, and nothing against or for anybody, but farmer loans are normally waived by the government, and Reserve Bank of India keeps on issuing instruction. The loan is never repayable once the waiver is announced. Your loan amount of 50,000 rupees, government of India or specific state government had said, okay, this year there was maybe a lot of flood, all your crops are washed out, no repayment of 50,000. It's okay, your amount is waived. But for this particular moratorium, please understand, this is not a waiver. This is only saying pay tomorrow, and that tomorrow is 1st June 2020. So all those who thought that, oh, government has given us a lot of help, it is my humble request that understand this help, how that help is going to impact you, and if it suits you, only then take that help. Otherwise, you never know, you may burden yourself at a future date due to availing of this facility today. Yes, the situation is very, very unique, and lot of people will need this help. But then before availing this help, all of you have done a right choice of coming to this chat and understand how this help is going to impact. I am moving to the next slide. Why RBI has announced this relief package, as we all know, to mitigate the burden of debt serving brought by this COVID on account of this pandemic, to ensure that the businesses and the community at a large remains viable for this thing. If people have to go back and pay their loan, they will not be able to restart their day-to-day business, and therefore all this will automatically mean that there will be a lot of disruption in the business. Hopefully non-payment of installment will bring some amount of viability back to businesses. It was felt that this temporary disruption should be managed with a cash flow management, and therefore it will mean loss of income to some businesses, individuals, and present measures will work for these individuals to actually ensure that they come back to normal life within 2-3 months, and therefore there onwards the repayment will become easier. So by the time we come back to normal, what can be done is the way we have put a lockdown on people's activity, let's put a lockdown on their repayment as well. A very simple and a very, very considerate, very, very human thought by RBI. But is it something which is suit all kind of a solution, or is it something which I also need kind of a solution? Let's look at it. At this point of time, if somebody wants to ask a question, or maybe Rajesh, it will be a good idea that we all ask how many people think that this was a necessary step from RBI, and most of the people in this country will benefit out of this. Maybe if
Yeah.
we can have a vote on this.
Yeah. So all of you, request you to suggest your opinion whether you think RBI making it mandatory for banks to give moratorium to everyone was a right move, or the previous thing where no one was on moratorium. If you want, you should go for yourself and say I want a moratorium, would have been right. So put your answer thoughts on the chat. And Ankit has raised a question. Yes, Ankit, in the current scenario, you have to go to the bank and say, I want my EMI to be deducted. I don't want the moratorium. Otherwise, you are under moratorium by default. So everyone, you can have your opinion. You can put your opinion, and you can put a scenario also based on which scenario you think. Okay. Siddharth says previous one was better. Yeah. Yeah, Mahima, interest will be charged during this period.
Yeah, Rajesh, just to clarify, interest will be charged but not payable during this period.
Yeah. Yeah. Ati, there is the option of repayment. Ati is saying that there should be option of repayment.
Yes.
So there is
So
option.
I think Ankit rightly asked this question, and some other participants are also rightly asking this question. Therefore, I am putting a very specific clarification, Rajesh.
Yeah.
It is important for every individual to go back to his bank's website or to the call center and understand what is the stand taken by his or her bank starting now. This is more specific from a point of view. Let us use this 1 minute additional and clarify this scenario. Reserve Bank announced this package somewhere around 25th or 26th of March. Fortunately or unfortunately, this starts from 1st of March 2020, the EMI payable after 1st March. So there was already a 26 days of the calendar which had already gone, and most of the people between 1st to 10th of the month had paid their installment for the month of March. So if your month of March EMI was already paid, now the question only arises for April and May installment. Now, therefore, once again, I am clarifying that banks are not necessarily considering every person under moratorium by default, in spite of this particular request which is come from RBI, or the clarification which is come from RBI. If the person wants to pay the EMI in spite of RBI saying that you are by default under moratorium, banks are now opening a SMS on the website, come and click your number, loan number, all sorts of options where you will be able to opt out of using the moratorium, which means I want my EMI to be deducted as per due date of April and due date of May. Please do not stop my EMI. Continue deducting my EMI can be a request made by the individual to the banker, but this request for every bank, the method may differ. Somebody may ask you for a SMS to be sent to a specific number. Somebody may ask you to come and input your number through the net banking on the website. So you have to look at your individual bank. I do not have, or we do not have, a ready-made answer of every bank and every finance company the way they are treating this option of not using moratorium by the customer. But yes, every bank has a window open for the customer to come and say, I don't need a holiday.
Yeah. Vinod, we can move.
Yes,
We
we
have
can
30
move. Yeah.
minutes left.
Yeah, sure, sure. So now we come to the crux of it. So RBI has given this, and it's obviously going to impact. So what is the effect of this particular moratorium will be on the people? So somebody who will avail the moratorium will have three choices, and obviously somebody who will not avail the moratorium will pay installment as per due date in the month of March, April, and May. So if you avail the moratorium, what are the three options that you have? One, extend your loan tenure at the end of the loan whenever your loan was supposed to end. Say example, your loan is supposed to end in 2025, you will extend the loan further than that. The second is you increase your installment starting 1st of June. Because the moratorium will end on 31st May, you can go back to your bank and discuss with them, and I'm not sure whether banks are accepting this as an option. Most of the banks are not accepting this option, that you increase the installment that I want to pay to the extent that my original loan last EMI date remains the same. The third option is go back on 1st of June and make the payment for all the three EMIs of March, April, and May, and then therefore your principal outstanding on 1st of June comes back to the same as shown by Rajesh in the amortization schedule. These three options will behave differently when it comes to your loan repayment. As a part of the moratorium, it can be demonstrated that each of this will behave differently. And that is the reason this Excel was provided to you. You will be able to, after taking a due guidance from Rajesh and his team, be able to change the options in the moratorium chart, in the repayment chart and the amortization chart, and see the impact of this particular. But these are the only three options out of which most banks are going to allow option number one. Very few banks will allow option number three, but very less chance, practically nil chance, that the banks will allow option number two to any of the borrowers. Increase the EMI will not be the option available, because it will mean a lot of changes at the bank, their own levels, in terms of system changes, in terms of understanding whether the customer can really pay a higher installment, and so on and so forth. So we are going to focus on option number one as a part of our discussion, while of course queries can be answered for option number three and option number two as well. But then the whole idea is that what is going to happen in case you extend the loan is most important. So here again, obviously, uh, Rajesh is going to take a very quick look. Rajesh, let's go back to the same example and probably show to team that you not paying the installment, and here Rajesh has done one more adjustment. As you can see, now there is opting moratorium kind of option which is come in this Excel. Rajesh will take it. Rajesh, once you explain this calculation, we have few of our suggestions to give to people of whether they should use the moratorium or not.
Sure. I've taken the control.
Control. Yes.
Yeah. Okay, I'm sure the screen is now available to all of you. My screen is visible. So here what I've done, and this is where Excel skills also come into play. I have set my loan. What was my original loan was, let me take it from here, 1 Jan 2010. So let me put it 1 Jan 2010. If I have taken my original loan on 1 Jan 2010 and I have an option of taking the moratorium, what will happen is my overall tenure is going to increase by 8 EMIs. So 8 months later, on 1 Jan 2010 is when I took, and 20 years. So by 1st Feb 2030, my loan should have been paid back completely. But because of taking the moratorium, here I have given option 1 and 0. If you see this drop down, if you take 1, it means you're opting for moratorium. If you take 0, it means you're not opting. And the moment you change this to 1, you will see here automatically it will find out which month is March. I've used some conditions. So here automatically in this Excel, it will detect these are the 3 dates where you are opting, which means you do not wish to pay. Automatically the payment made flag will become 0. As soon as the payment made flag becomes 0, your interest is still charged. The preceding month you had 35 lakh 32,000 to be paid as part of the schedule, but you have said I want to opt. The interest of 26,497 is charged, and that gets added to your principal amount. As a result, what will happen is your principal increases the next month because you did not make the EMI payment. On this principal, once again you have an interest being charged, and this interest will get added, and your principal outstanding increases, which means the interest component in a moratorium gets added to your principal because you're not paying the interest. Because you're not paying the interest, your principal outstanding is increased till this date. From here, when you opted for moratorium, your principal is increasing rather than decreasing. So the increase in principal is of around 80,000 rupees in this case. And because of this small increase in 80,000 rupees, a loan which you are paying 44,986 every month, you will end up paying 8 more EMIs because your loan will not get completed on 1 Feb 2030. It will now get extended till 1 September 2030. The maximum people who have taken, yes, Arti, 8 more EMIs, approximately 8 more EMIs of the same amount. And if you see a person who would have taken, assume the person would have taken a loan on 1 Jan 2020, the impact would be much more severe for that person. 1 Jan 2020, that person will end up paying 19 more EMIs, which means he has to pay more EMIs. So this is the impact of taking moratorium. In case you do not take moratorium, your loan will end as per the stipulated date. Okay, so here I scroll up. These are the numbers. The loan gets ended exactly on the stipulated 20 years down the line. But in case you take the moratorium, the Excel populates additional details and it shows you your loan will get ended on 1 August 2041, which was otherwise based on 20 years, it should have ended on 1 Jan 2040. So 19 more, almost 19 more EMIs, it works out. So it may appear very simple that RBI has given you a moratorium of 3 months, It all depends upon whether you took the loan recently or whether you took the loan 10 years or 15 years back. Because if you have taken the loan 15 years back, you are now paying less interest, more principal. So the interest component which gets added to your loan is smaller. As such, the tenure increase will be shorter. However, if you have taken the loan recently, in the initial EMIs, interest amount is higher and principal is lower. So a good amount of money is getting added to your loan principal outstanding, resulting into higher tenure. So this calculation is what, as a financial analyst, you have to understand. It seems very simple, 3 months moratorium, but the impact of 3 months can be 18 months, the impact of 3 months can be 8 months, the impact of 3 months can be 1 month. You really don't know. Definitely there is a benefit which the government has given. No, Ati, there is no straightforward function. You have to do all these Excel calculations, which I have done. So government has given, there may be some people who will not have cash flow. And because of cash flow, if they don't pay, they will be termed as defaulters. Their credit history will get spoiled. Government does not want, RBI does not want the credit history to be spoiled. That's why they have given this option. So I make Vinod back the presenter. While Vinod is explaining, you may probably also once again want to play around with this Excel. We have already shared this Excel. Vinod, back to you. You should help probably the students and the participants how to make a selection choice, whether they should go for it or not go for it.
Yes, Rajesh. So yes, the impact is very, very severe. COVID is impacting every aspect of our life and most importantly, the pockets. So what's the choice one has to make? Let's go to that. $1 million question today. Should I avail the moratorium option? And as we demonstrated, we said you should avoid availing that, and therefore my choice to people who can avoid is no, you should not avail the moratorium. And the reason of that, if you have enough cash flow to pay your EMIs. Now, who are the people who are likely to have this kind of a cash flow? So mind you, on behalf of the government, Prime Minister and various regulators have been very regularly requesting, making suggestion that continue to pay salaries. So if there is an individual who got his salary credits, there is no need for him to feel that how will I pay my EMI, because you got your money as a salary of which you are what supposed to pay the EMI. Why take a moratorium? Go and pay your EMI. Salaried individual, typically with maybe a dual income, and therefore maybe you had taken the loan only using one income source. You have a backup. Please go and pay the EMI. Please do not avail the moratorium because it is going to financially impact you. Self-employed people, if you are sure that you can manage the cash flow for the rest of the month, then on that due date you should go and pay the EMI. And any other person who has sufficient savings of the past to take care of these three EMIs and very sufficiently sure that his life is going to be normal after the COVID lockdown. But I'm only hoping that most of the people come into this first category. But yes, as we see around us, there are people who may have a constraint on the cash flow. And if you are seeing the person with a constraint of the cash flow, there is no denial that he can use the moratorium. People who may not have received salary at all, or may have received a very part kind of a salary, with nil or a marginal saving, because future is uncertain, so we don't know how it is going to impact. So people with marginal savings should not use up their other savings to pay the EMIs. People with multiple loans and credit card dues should obviously not use up all their balance to pay off the loans and credit card dues. And people who are constrained of their current and future cash flows by any means, the self-employed person, he himself has to pay salary to his employees, so obviously he will be constrained with the cash flows. So we don't know the answer for every person. Individually will have to make a choice. If your pocket allows you to pay the EMI because there was a cash flow which has come even during this lockdown, please go ahead and pay the installment. Do not avoid making the using the moratorium and making the payment after June. It is better to release your burden, as Rajesh was rightly pointing out, that we Indians believe that it is good to get rid of somebody's loan as fast as possible. But that brings us to a very interesting point here. And as Rajesh rightly said, that you should use the Excel to understand the impact. You should use these points which we have raised to understand every individual, whether he or she should avail the moratorium or not. But if at all a person comes with a constraint of a cash flow, is it really possible that you could have predicted something like this will happen and planned it in advance? Probably the answer is yes. Uh, Managing cash flow during the loan, people makes a lot of choices and then take a loan, but it is possible. Some of the common issues which are faced is, funds are available, and I have excess funds once I take a loan. The situation that, as Rajesh rightly pointed out, over 20 years, one's cash flow do not remain the same. 20 years back, somebody's salary was different. Today, it may be 5 times bigger. So, if a person has a money over and above his installment, what does he do? He keeps it in the savings account. But his savings account will give him only 2.5% interest rate, because RBI has now reduced, SBI has reduced the interest rate 3%, whereas your loan is going to charge you 9%. So if you have a loan, if you have excess money, there is a tendency to either save or go and very quickly, instead of waiting for 20 years, within 10 years, 9 years, 7 years, let me repay my loan. The trouble there is, if you pay the money in the past, so imagine somebody who went in 2019 and made a bulk repayment. Today he must be regretting, had I kept that money with me, maybe I could have paid these 3 EMIs because my salary stopped. So should you prepay? Should you not prepay? Right? If you keep the loan on your head, there is a social and emotional pressure which keeps building. So there is always a choice that one has to make, whether to keep the cash with him and keep the loan burden, or pay off the cash and keep on reducing the loan burden, but it will never become zero till you actually make it full payment. So keep on part paying the loan and coming to a situation where you may or may not be able to really come to a right choice. So how does one look at this as an option? People should use overdraft as their choice for the managing cash flows. And why am I suggesting this is, under EMI, your obligations are fixed for the month, as we have shown in the example, 44,000 rupees. Whether you have the money or not, your obligation for the month is 44,000 rupees. It will not change, it will not reduce. You have a fixed due date, right? But when you take the overdraft, and mind you, even a housing loan, a personal loan is available now under the overdraft method, and it is therefore possible that you can pay extra money in your overdraft account and reduce the burden of this thing. Because of it is an account and not an EMI based amortization schedule, there is no fixed due date burden on that. That's another advantage that the overdraft brings. Amount once repaid under the EMI method cannot be reused. But in the overdraft account, if you have made the excess payment, the money which you have paid excess is reusable. Interest charge is a very constant charge for the month. As we all have seen, there is an amortization schedule. For the given 44,000, there is a perfect breakup available. for each month of how much is interest and how much is principal. But here, if you have paid more money into your overdraft account, the interest charge is going to reduce for that particular month, and thereby you will be able to limit the interest that gets paid. uh, you need fresh loan every time you want to take a loan under the EMI method, because once you have used the loan, there is no fresh money coming to you. But under the overdraft, the concept is you have a credit limit and there is no loan amount. The credit limit unutilized is equal to your fresh loan available. Every day morning, if you have yesterday put extra money in your loan overdraft, today morning you have a fresh loan available. And it works very well for the people who really have to juggle for then every now and then they need more money, or suddenly they keep on getting cash flows, particularly the business guys who have every day more money coming in, more money going out. Overdraft is the best option. Needless to say, the interest rate charged by the banks and the finance companies on the EMI is little less. When I say little less, let me just give you a simple comparison. SBI charges say 8.75% on their home loan, and on the overdraft they charge you 8.85%. So it's a very marginal betterment. But yes, the EMI method charges little better interest rate, but when it comes to actual interest calculation, overdraft method saves lot of your actual interest payment. So there is a possibility that one can use options like overdraft and manage situations like COVID moratorium, where the cash flow is suddenly stopped, but you have a loan obligation going on, and you can manage your cash flows much better with overdraft kind of facilities. I am not at all recommending that EMI is not a suitable option. All what I'm saying is, if one is very sure of managing his cash flows better, overdraft can be one more choice, and it's a risk-free choice. So that brings us to end of lot of discussion. Um, in case any one of you have any queries, we still have about another 6-7 minutes to go. Rajesh, if you want to add anything or any other, you know,
Yeah.
any other suggestion.
In a session, I had asked which loan has got lower interest rate, home loan, personal loan, or car loan. Uh, the answer is home loan has the least interest rate. The highest interest rate is charged for personal loans, and car loans is between home loans and personal loan. The reason why home loans has got the least risk is because when you buy a home, you are emotionally attached to it. That is point one. Second is home is not mobile. It cannot be moved. It's not movable. It's a fixed structure. So the value of home does not depreciate very fast. So from that standpoint, it is a much more safer asset. That's the reason why home loans have least interest rate. When it comes to car loan, once compared to car loan and personal loan, in a car loan you have car as a security. In case you do not pay the EMI of car, the bank can come and take away the car. So there is some value they can again get back by selling the car. Whereas personal loan is completely unsecured. There is no security which you give, there is no collateral that you give, as a result of which personal loan interest rate is the highest. Now between home loan and car loan, why home loan is lower compared to car loan? Because home is not movable, you cannot have damage to home very fast, whereas car is movable, you can get it damaged by way of accident. Okay, so that's the reason why there is a slightly higher risk in a car loan as compared to home. So car loan is priced relatively higher in interest rate. So that's what we have. And let me just quickly go if there are any queries that we have missed answering.
Rajesh, with your permission, one last
Yeah, go
point
ahead.
I want to make. It is possible in the life of a loan that a person can change from the EMI to a overdraft structure, as we have suggested here. If somebody really wants to know that whether an existing loan can be changed to a overdraft or whether my existing EMI is going right or not, we can provide that kind of a support. Our email ID and mobile number is available.
Yeah.
One can keep on making these kind of choices. But of course, the whole idea of this presentation was to say that moratorium, if availed, is going to eat a lot of cash in the future.
Yeah, as I mentioned, Vinod has got extensive experience. He comes with 30 years of experience in risk marketing and operations, part of banking and financial services. So with that privilege, Vinod, I've put his email ID just in case you have any finance related queries. You can probably take this email, note down this email, and you can also note down his mobile number. You can reach out to him for any individual level support. And because he has worked with banks and financial services, he has got contacts in the banking and the financial services domain. He may also be able to help you out in case you have a loan going on. He may be able to help you out, get your home loan EMI based get converted to overdraft based loan. So that's what we have for the session. I am sure you would have got a good amount of insight from this session. And if you have really liked the session, I have a very humble request. We as an organization keep doing these webinars, and we are a training institute. We like to spread knowledge, and to spread knowledge, it is very essential that you connect us to more people. And if you really liked it, I'm sharing a Google review link. You may kindly go on this Google review, check various past reviews, and if you like the webinar, I request you to give 5 out of 5 for the session on the Google review. On the meetup also, in the comment section, you can post whether you liked our webinar. This will help more people to join this kind of webinars. Our upcoming webinar is on data science. Coming Saturday, Saturday or Sunday, I don't recollect the exact date, but we have got a upcoming webinar on data science. Two of our students who actually did the course, one of the student actually moved from a MIS developer role to a data science role, and the second of the candidate has actually moved from a boiler industry. He was a supervisor in a boiler industry, and he switched to data science. So these speakers are going to come. Watch out this space. We'll soon have webinars on COVID-19 impact on telecom industry, and we will have an upcoming webinar on number plate recognition. It's a high-end data analytics course session which we will have, where we'll help you understand how by image processing you can have number plate recognition. Just by reading an image, the program will say what is the number plate. It may seem simple, but it involves lots of image processing. So some of these webinars are lined up, which will be happening in our upcoming weeks. So look forward. My colleague Himanshu has already shared the invite of data science journey on the chat box. You may please click and register yourself for that webinar. This is our blog page. Detailed blogs on linear regression is there. More blogs are coming. Statistics is what we are adding, and we are soon launching a full-fledged course. If you are interested, you can take up a full-fledged course where we talk about lots of domain in analytics. Remember, domain knowledge is of paramount importance. Besides learning R programming or a Python programming or a Excel, end of day, you are solving a business problem. Our focus in our data science courses is completely on domain. We try to teach domain, and through domain, we try to solve a machine learning, use a machine learning technique. Because domain is of paramount, our thrust in our techniques and our training is also on domain. Any queries, if there are, you're free to post. We'll be here hanging around for next 5 minutes. It's exactly 5:31. We are bang on time in concluding our session. If you don't have any queries, feel free to disconnect yourself.
Thank you all for participating. This is signing out, Vinod.
Thanks, Vinod. I appreciate your time that you have given for this session.